You place a stop loss. Careful, responsible. You've done what every trading book tells you to do. And then it happens. Price dips. Just for a moment. Your stop loss gets hit. You're out. Seconds later, price reverses. Hard. Runs straight to your target. Without you. It feels personal. Like the market looked at your order and hunted it. Here's the uncomfortable truth most traders never fully accept. The market didn't move against you, it moved through you. And that difference explains why stop losses get hit right before reversals, again and again and again. This matters right now because more people are trading than ever before. Apps made it easy, leverage made it exciting, and stop losses made it feel safe. But safety in markets is rarely what it looks like on paper. Let's slow this down. Imagine you're not a trader. You're a casino. Your job isn't to predict the future. Your job is to manage risk and extract liquidity. That's exactly how modern markets work. Most people think price moves because of news, or indicators, or patterns. Sometimes it does. But most of the time, price moves because of orders. And stop losses are some of the most predictable orders in the entire system. Think about what a stop loss actually is. It's not protection. It's a delayed market order. The moment price touches your stop, your order becomes fuel. Instant buying or selling pressure. And here's the key detail almost nobody internalizes. Stops cluster. They don't scatter randomly across the chart. They pile up. Above obvious highs, below obvious lows, under round numbers, at levels every YouTube tutorial points to. Support, resistance, the safe stop placement everyone learns. From the market's point of view, that's not protection. That's a map. Now enter the other side of the trade. Large players don't trade like you. They can't. If a fund wants to buy millions of dollars worth of an asset, they can't just click buy. There isn't enough liquidity sitting at one price. They need sellers. And where are guaranteed sellers hiding? Right behind your stop. So price doesn't reverse after your stop by accident. It reverses because of your stop. This is where the irony starts. Retail traders place stops to avoid big losses. Institutions use those stops to enter big positions. Same mechanism, opposite outcomes. Let's walk through a simple scenario. Price has been falling. Everyone sees a support level. You buy there. You're not reckless. You put your stop just below support. So does everyone else. Price drifts lower. Volume dries up. It looks weak. Then, suddenly, one sharp push down. Not a collapse, just a clean, fast wick. Your stop triggers. So do thousands of others. All at once. That wave of sell orders creates liquidity, exactly what large buyers were waiting for. They absorb it. Price snaps back up. And now the chart shows a perfect reversal candle. Textbook. Beautiful. The same candle that convinces you the market is rigged. But nothing illegal happened. Nothing secret. This is just math meeting human behavior. And the math is brutal. Most retail traders use similar position sizes, similar strategies, similar stops. That means the probability of clustered stops is extremely high. Markets don't hunt stops out of malice. They gravitate toward liquidity like water flows downhill. And stops are liquid. Here's where it gets uncomfortable. Even when you're right about direction, even when your analysis is correct, you can still lose money. Because timing and order placement matter more than being right. Being right early feels exactly like being wrong. Now let's talk about volatility. Price doesn't move smoothly. It pulses. Compression. Expansion. During low volatility, stops feel safe. During high volatility, stops are magnets. And volatility has increased dramatically over the last decade. More leverage, more algorithms, more reactions to the same data, which means the distance between noise and trend is wider than most traders expect. Your stop might not be wrong, it might just be inside the noise. This is where hype collides with reality. Trading education tells you, always use tight stops. Risk management is everything. Cut losses quickly. All true, and still incomplete. Because risk management without understanding market structure is like wearing a seatbelt in a demolition derby. You're safer than nothing, but not safe. The system rewards those who can wait and absorb volatility. It punishes those who must exit at predefined levels. That's not a conspiracy, it's a consequence of scale. Now zoom out even further. This isn't just about stop losses. It's about how modern markets are designed. Liquidity is fragmented. Price discovery is automated. Algorithms react faster than humans ever will. Your stop is visible to the system, even if it's invisible to you. Not your name, not your account, but your behavior. And behavior, when repeated millions of times, becomes predictable. Predictability is exploitable. That's the part no one likes to say out loud. So what do traders usually do after getting stopped out before a reversal? They widen stops, then losses get bigger. Or they remove stops entirely, then one bad move wipes them out. Or worse, they revenge trade, chasing the move they should have caught. The market doesn't need to beat you, it just needs you to beat yourself. And it usually waits until frustration does the job. Here's the quiet truth. Stop losses don't fail because they're useless. They fail because they're obvious. They're placed where everyone else places them, at levels that feel logical, clean, and safe. Markets don't respect comfort. They exploit consensus. So the real question isn't why do stop losses get hit before reversals? The real question is this. If everyone knows where the exits are, who do you think controls the door?